Start with the usual disclaimer. These does not represent the views of the Federal Reserve Bank of New York or the Federal Reserve System. Since those are some very preliminary thinking about a set of issues that bother me, my connection to the international reform agenda is really in the world of resolution, trying to reduce the too big to fail problem. And the reason to think about financial franchise, first of all, it was one of the top lessons learned for our supervisors when we reviewed what happened to during the crisis, was this sense that we didn't understand well enough how banks were actually making money and therefore what was going on inside those institutions. A second, of course, is that there is real anxiety about these very large institutions not understanding what the consequences would be if one actually had to liquidate or sell in pieces a failed firm. And finally, I think there is a public policy question, which to me is part of the anger that we see in the political sphere and in the general public versus the large banking institutions, financial institutions in the U.S. And that is really they are all operating with a license or a charter granted by the authorities, and where is the value added to the public. So it's a troubling set of issues, but narrowing this just a little bit, also franchise value can be an important aspect of aligning incentives. And my colleagues, this is a paper from quite some years ago, Rebecca Demsetz, Mark Seidenberg, and Phil Strawn, had looked at this question for traditional commercial banks, how important having franchise value in the organization was to causing management to want to safeguard the firm. They had something to lose, not bet the bank, and reduce moral hazard more generally. I'd say that's challenging in today's world, in that these are much more complicated firms, as Graydon talked about a little bit, more complicated firms, and Joe too. And so there may be issues there, but again, really trying to look at where does the franchise value come from these firms is a very important question. So what do we know about assessing franchise value? I think we've all learned the same stuff about discounted future cash flows. That's where the value comes from. My colleagues in writing that paper on franchise value back in '96 also talked about trying to measure the firm-specific franchise value, what was unique about the firm, by looking at the difference between the market value and a sort of replacement cost value, similar to a Tobin's Q kind of measure. What I'm going to suggest is that those measures are really not robust to two kinds of things. One is that the competitive environment has become so much more dynamic, and so kind of extrapolating earnings on into the future can be very problematic. And second, and I think this is the heart of what I'll talk about briefly here, is that in addition, the kinds of problems that we have seen, and particularly in the trading businesses, the capital markets activities that Graydon indicated was one of the key definers of institutions that required a bailout, those kinds of problems are not really, and their consequences are not really captured very well by the frameworks in which we tend to look at financial institutions. There are a lot of activities in financial institutions that I think are really quite suitable for the model, the kind of classic way of looking at franchise value. Many produce annuity-type returns that are steady and reliable, not too sensitive to the cycle. But then there's a number of activities that firms now engage in that I think have characteristics that are different from the characteristics of a lot of those annuity-type businesses. And I think one, obvious important issue is to try to figure out what is that kind of difference. So I'm drawing on three perspectives and thinking about this, and this is really more of a thought exercise than anything else. This first one I'll just go over very lightly, and that is I don't think we understand yet enough about the competitive environment in which financial firms operate. Again, I'm personally very involved in the payment system. What is happening in the payment system, as many of you know, is that banks are the traditional providers. There are some other financial utility type of providers of clearing and settlement services, but the big thing on the horizon is PayPal, Google, people that are providing very different services. And how do we capture that dynamic in this environment? And in particular, what is the role of innovation, and what should we as supervisors be looking at in that kind of very innovative environment? The second perspective comes from a literature that's been around for a while, but is, I think, of relevance here, and that is the literature from Credence Goods. And now I'm shifting to the world of capital markets activities. I've got a sort of a definition here that I borrowed from the article of what a credence good is, but this is really talking about fundamentally an asymmetry of information between the clients on the one side and the provider on the other side. This is a literature that talks more about physicians and plumbers, personal services, than it does about financial services, but I think it's useful to look at that particular literature because what are the problems there from a sort of efficiency standpoint? There can be an undertreatment of a problem, that is, it wasn't really fixed, an overtreatment, that is, you got more treatment than you really needed, and finally, you can also be overcharged for the amount of treatment that you got. And I think there are parts of the capital markets where this asymmetry of information or disparity of knowledge can be very significant. I've listed some here. I think an area, for example, such as the most complex securitized transactions is one where it's not even clear that the providers fully understood what all the risks were. But again, real problems in terms of how that market is going to perform. The interesting thing from this literature is that, as that recent 2011 article was talking about, so what are the solutions? And I was really struck in reading through it, the emphasis that the authors put on legal liability. Not something we think about in the financial sector very much. And in fact, I go farther. The institutions in the financial sector, such as arbitration for securities disputes, really discourage. I mean, you sign up with your broker, you're going to sign a form which says, you're not going to seek damages in a court. Instead, you're going to go through the arbitration process, which is, many articles have talked about how flawed that particular process is. So again, I think this literature is useful because it may open our eyes to solutions or roads that may help us in dealing with these problems, which I think are present. But they may also be helpful because they may suggest to us where some of the solutions could be quite weak. So sometimes there's a lot of emphasis in the economic literature in talking about financial institutions on reputation. And yet this literature points out reputation is, it's better than nothing, but it's not really strong. And again, if you think about the recent crisis, many institutions have very fine reputations going into the crisis and, obviously have exited the crisis with most of that reputation tattered. And a third perspective I think is worth looking at is, the tragedy of the commons. I feel like a one-note person on this particular subject, but to me, a great deal of the financial market infrastructure, the setup, is actually a commons. It's shared by all firms. And we've had the historical experience both in the early 90s when the CMBS market collapsed and also more recently in the private securitization markets, that when practices are not good, when the marketplace is abused, when consumers and clients and institutional investors come away abused, that's not just bad for the bad actors, it ends up being bad for everybody, and actually bad for often for the economy as a whole. This issue of the decline of the commons is a big topic these days, a surprisingly big topic, in part because it's, of course, really happening. And I think also there are interesting ideas. And again, putting forward this one article that talks about the issues in areas like forestry and fishing, renewable resources of one sort or another. And the focus there is on the enforcement of whatever market rules are set up, and the market rules being the harvesting rules in the case of these natural resources, but also the great subtlety that's involved in coming up with the right rules and whether they'll even work based on things like how much capacity there is in the system, and overcapacity is certainly, and it has been an issue in the financial sector, or whether you can really earn a competitive return. And this resonated with me a great deal because we're living in a world in which technology is busy scraping away the return, the competitive return over time in many financial activities. I wanted to just talk briefly about how do you use stuff like this if we were to advance a framework more along these lines. I look at something like Triparty, Repo, and Securities lending. Okay, somewhat obscure businesses, but definitely the part right at the center of some of the problems during the financial crisis. The Triparty Repo and Securities lending are both cases where someone holds a security, someone else takes that security from them and gives them money in return, always collateralized in some form. So that market, those are both markets that have been around for a long time. They were always based on really liquid securities, U.S. Treasuries, comparable types of securities. In the run-up to the 2007, 2009, those markets really started to expand to far, far less liquid securities. So they were becoming ever more profitable businesses. Again, extrapolate out the cash flows, and it looked very, very rosy. And I think if we had done a very thoughtful, risk-adjusted, franchise value calculation, we probably would have picked up higher risk in this business. But I don't think it would have been easy to pick up that those businesses could effectively collapse and the entire income stream collapse and never come back again. And yet, if we had really thought more about what is going on with highly illiquid securities like CDOs or very structured finance transactions that were somewhat impenetrable, in cases like that, you might have drawn the conclusion that indeed there was going to be destruction of franchise value coming out of the end of the episode. And I think another way that we could use this kind of thinking about franchise, kind of expanding our minds about franchise value, is really in coming up with a table like this, which I realize is incredibly simplistic. But, if we could categorize the kind of goods and services provided by financial firms according to the one side of the chart, which is talking about sort of, traditional services, core services, then these credence-type markets, and then the more commons-type markets, which might be actually a subset of the credence markets. I think we could talk about what tools we have, what private sector arrangements there are, in the first place, to manage incentives, what supervisors could be paying attention to that we learn out of this literature, and last, what supervisory tools that we should add to the toolkit, or simply understand better how the tools fit together in a better way. Right now we have legal jurisdictions that determine what tools exist, and activities that cut across those jurisdictions. And I think really rationalizing the toolkit more could be, along activity lines, could be very, very powerful. So to wrap up, I'd say we have franchise value is a window on the health of the financial system. There's a lot of evidence that suggests that low franchise value and excessive risk-taking are linked, and I think that's echoed in some of the presentations you've heard. When we can try and dig deeper into franchise value, we may have a better foundation for determining the health of a firm, and we also may better understand what the role of supervision can be and what the overall toolkit, including the private sector arrangements, can be. So we can add a few things to the chart I put there from the presentation, maybe no size limits, but Eugene asked the very powerful question of, how much should be in the private sector versus how much are we relying on supervisors, with maybe a bias to say maybe a little too much on the supervision side. I think Graydon raised a number of points about where the pain points are and the trigger points are in terms of institutions that get in trouble. And then, of course, liquidity being one of these very shared features of the financial system, where even a strong banking system can't escape its impact. So that's our panel. Now I'm going to pose a couple questions to the panelists, and then we're going to turn it over to you for questions. And I think the mics are going to work on the table. So the first one is really to ask the panelists, if our goal is to prevent a large-scale financial crisis in the future, what tools do you think need more attention? Which tools do you think will be important? What would your advice be?
I'm going to use this as an opportunity to put in a plug for a relatively new instrument that I think is very important and hasn't received a lot of attention. I think most of you are familiar to some extent with Basel III. And it calls for more and higher quality capital. Okay, that sounds good. There's an additional element that's part of Basel III capital regime that hasn't received a lot of attention, and that's the countercyclical capital buffer. And I think from an economics perspective, this is very attractive. The traditional view of capital is there's a certain amount that you hold on to at all times, and you never let it fall below that level, or you might be considered non-viable. I suppose as a resolution mechanism that's helpful. But economists tend to think in terms of cycles, and we know that the risk varies over the cycle, and a constant level of capital is not responsive to that. The countercyclical capital buffer exists in Basel III. I don't think it's received a lot of attention, and this is the tool that I personally would put some hope on in terms of helping us prevent the next crisis. It's relatively small. It varies between 0 and 2.5%. The idea is when risk is low in the financial system, it's 0. But as the supervisors or sort of the financial stability authorities view risk rising in the banking sector, you can raise the capital requirement by up to 2.5% or more if you're so inclined. The idea that we can therefore have capital, the amount of capital vary over the cycle is very attractive from an efficiency perspective. The trick, of course, is knowing when to raise capital, which means you have to predict to some extent when risk is rising in your financial system. There's a great research agenda there if some of you would like to pursue it. This is work that I can guarantee is being pursued in every central bank around the world, and also by the major financial institutions, the IMF, the FSB, BIS. But I think we have to think about capital differently, and to the extent that we can view it as something that varies over the cycle in response to the level of risk in the system, I think is a much more attractive approach relative to what we used in the past, and could be very helpful. We just have to learn how to use it. Thanks.
Gene?
Yeah, it's a little bit of trepidation to take on a practitioner, but I think I'm going to disagree with that, because what I worry about is the increasing complexity of rules which are imposed on for instance, capital rules in attempts to control risk, because there's always some way to, I think, eventually have lawyers engineer around it. I'll try and lighten this for the moment, but I often think about children. You can set many different rules for them, but they always find ways around. One of my favorite stories is from Theodore Roosevelt, and he was furious with his daughter because she was smoking. And he says, "No daughter of mine is ever going to smoke in the White House." So what did she do? She went on the roof. And I think one of the problems with these is it's hard to see what, and regulators, I think regulators have to respond to the incentive sent by the Congress and Parliament to do something about this. But I worry about the complexities, because every time in the past, the institutions have engineered ways around these fixed rules. One example of that is fiducia in the US, where they said there's too much discretion. We're going to go to prompt, I forget what it's called, but
Corrective action.
Prompt corrective action. And I can point to articles which show how well this worked to get banks to raise capital when they needed to do so. The problem was that once you set this very specific agenda, anything which isn't on the specific agenda is free game. So it's kind of beyond the blinders of the regulators. So what happened was all the activity which occurred through all the extra vehicles outside, which wasn't taken into account, and you get a disaster which is building up in this way. So I would put a greater emphasis much more on types of contingent capital where you have liabilities for the people who, it's a much more market-oriented way rather than a structured way. And so a different view.
Joe, maybe I can ask you where you think maybe the biggest information gap or knowledge gap that we have right now in thinking about systemic risk and too big to fail.
Well, I guess I would follow up on Eugene's point that the risk-taking incentives are significant at the largest financial institutions. And we've seen now a series of papers coming out looking at the banks that fell the farthest during the crisis. And before the crisis, the article calls them the heroes of the day. They were stellar performers. They were maximizing shareholder expected value. And they hadn't anticipated this crisis tail event, but they were maximizing shareholder value. And the Marcus problem that there are dichotomous incentives for risk-taking. The banks with high-value investment opportunities operate safely and protect their charters, and the banks that have low-value investment opportunities exploit safety net subsidies. And there's every evidence that these institutions that fell the farthest were the most successful prior to the crisis and exploited all manner of opportunities to take risk. And interestingly, some studies look to see whether governance played a role here, where the institutions that fell the farthest during the crisis poorly governed relative to those that weathered the crisis reasonably well. And the evidence shows that the institutions that fell the farthest were the best governed. So again, by the standard governance metrics, it appeared that they were really maximizing shareholder value. And so Chairman Greenspan, in Senate testimony, observed that he'd always anticipated that managers would maximize shareholder value, and this would lead to safe and sound practices. But as he said, he stands now in a state of shocked disbelief. So I think that's the incentive issue, and Eugene pointed some of these, the double shareholder liability that protected banks' safety and soundness in the national banking era. I don't have a solution.
Well, I think it's time to let the audience ask some questions. So what I'd really urge you, there's a microphone, and give the folks with the microphone a chance to get to you, so this everyone will hear, and also that it will be recorded. So, any questions from the audience? Oh, great. Please. The gentleman, okay, this gentleman, and then we have another.
Yeah. I have one question to the presentation about the scale effects and too big to fail. Have you also considered, or are your results robust if you take into consideration the bank size in relation to the economy, the size of the economy? So I think about Switzerland, where there are huge banks like UBS, and a relative small economy, maybe in this case, I don't know, the too big to fail effect plays a role in comparison to what you found for the US also.
I'm not sure I'm going to answer your question, but there's a paper, and I should have brought some notes with me. There's a paper that looks at scale economies of banks as they operate in larger financial systems. And obviously this is a global system you're talking about, even though it's Switzerland. And the larger the financial system, the stronger the scale economies given size. So there's an interaction between the bank's size and the environment in which the financial environment in which it's operating. And these authors, I wish I could remember who, call them systemic economies of scale.
There's a gentleman here in the third row. There we go.
Yeah, I'd like to comment briefly, as a matter of fact, ask you a question, because you stated that before the crisis, that firms which failed during the crisis were very successful. And my question is, were they really successful, or they created an image of being successful with the help of various financial indicators and ratings, and as a matter of fact, and in reality, inside they assume too high a risk. And therefore I have a question to Mr. Pauline, that is, because you said that sound risk management is absolutely the key, and then that banks themselves, or should themselves, make a priority of risk management. And I like this statement. However, I do not fully understand. I would like to ask you for some explanations, because when you say that banking systems should, or banks themselves should create such conditions, I'm thinking immediately of, for example, local governments, which assume too high a risk, or about the whole economies, which assume too high a risk and have very high, or assume a very high indebtedness. I'm not naming several countries. Thank you.
You want to take that, or does someone want to take it?
There were two questions there. I'll answer the second one.
Yeah.
Sure. Okay, I struggle with that a little bit. Yes, I did say, of course, banks themselves have to put increased emphasis on risk management. And in that respect, I agree with what Eugene said earlier. I just think we're going to have regulatory rules as well, and we might as well make them as efficient as we can on top of that. But the question is, sort of, how do you make this happen? We can try to force it, of course, by creating a lot of rules, and then, of course, you have the arbitrage problems. So therefore, my argument, which is, I have to admit, it's rather subjective, is you have to create an attitude where this is seen as the norm. The fact that our supervisory agency decided to have somewhat higher capital than Basel II minimums or leverage ratio, may have been helpful, but in themselves, I don't think it made a large difference to outcomes. What I think that was representative of an attitude that strong risk management was expected, and that permeated through the system. I admit this is somewhat subjective, but it's consistent with the results that we saw. So it has to be an attitude that is adopted. I don't think it can be forced. Well, I think you can do some positive things with regulation. This is not an argument against regulation. I just don't think you can depend entirely on that. You have to find a way to get that attitude to permeate through the system. I think we manage that in part, as I said, because of some of our historical experience, which showed the large losses that can be experienced.
I might add to that part of the regulatory agenda, both here in the United States and internationally, is not to assume that the risk management is always going to work. And so, the two important innovations in supervision over the last, since 2009, one is the stress tests, which really do try to contemplate what's the financial impact if things don't go well and earnings fall off, et cetera. And the second is the work on recovery and resolution, particularly resolution. And as many of you know, in the United States, the 9 largest firms including some foreign firms, were asked to submit resolution plans under Title I of Dodd-Frank, which is essentially bankruptcy. Bankruptcy, like any corporation, faces bankruptcy. And very interesting process. The supervisors are getting close to the end of working through those submissions, but very insightful in many ways. And so what do both of those exercises do? They really force management in the firms to confront the most severe risks that they might face. And that, that's a conversation you couldn't have had 10 years ago. It just, would have been off the table. So very important innovations, I think, in terms of both supervisory thinking, but also in the climate being created inside firms. Did you want
So yes, I mean, I agree with both those points, and I think that one must always, and those are all creating the right sorts of incentives to manage risk. And since I was a little harsh the first time, let me say something. Is Americans, which all Canadians know, Americans just think of the North somewhere without realizing it's the great comparative laboratory to compare the operations. And just two examples, which are very instructive. And again, I base this on just discussions with Canadian banking economists. But Canada, as I understand, had an equivalent of Fannie Mae. But we all know the problem with the US was that there was an incentive contract for a performance contract for the chief executive, which may help the organization go wildly out of control. Whereas I understand in Canada, the person had a nice fixed $100,000 a year salary. Very different incentives, very different results. The other thing is we have a new Consumer Financial Protection Agency in the US, which is endeavoring to do something. And I don't know much about it, but I think that they really should invite their peers from up north down to give a seminar on how to do it. Because if you go to their website there, what you'll find, and this has to bearing on Credence Goods and so forth, is one of the best things they do is that they provide information. You can type in where you live, what products you're searching for, and you'll get a spreadsheet which allows you to compare all the institutions across the way and do things which you can't normally do, and which make, it really reduces the information asymmetry in a very cheap, efficient way. And I can only hope that we learn and imitate.
Anything from you, Joe? Or?
Well, I was reporting on a paper which was not ours, my co-authors, but that was looking at banks that they didn't fail, but they did very badly during the crisis, and banks that didn't do as badly during the crisis, and how did they do before the crisis, and the banks that did very badly did very well before the crisis, and vice versa. So if you think of that risk-return frontier I drew, the heroes before the crisis were at point D, and those that weren't heroes before the crisis were at C and B. And after the crisis, you got the bad realization of the risk, but they were maximizing shareholder value, expected value, before the crisis, and were responding to the incentives of, apparently, according to another study, good governance mechanisms. So that was the point I was trying to make, that there are incentives to take risk, and we would say this is market discipline at work. But the market discipline is not working to produce bank stability. For some of the largest institutions, it's working in exactly the opposite way. And Loretta Mester and I have a paper on the Federal Reserve Bank website, Philadelphia Bank website, on a primer on corporate governance of financial institutions. And the full title is For Those in a State of Shock Disbelief. And we review how market discipline can work perversely, but we review the papers of the kind I just described.
It's interesting in this Delbeck et al. Paper on Credence Goods that there's a portion of it that's experiments, these simulated experiences to try and capture some of what happens when you have these kind of information asymmetries. And the interesting observation they make sort of towards the very end is that it appears, you get a lot of outcomes that don't really quite fit the theory, and it really appears that people's sense of fairness and et cetera actually play a role in those outcomes. And so I just sort of enlarge on that by saying, it's very uncomfortable to talk about, and especially for economists to talk about, but the value systems inside these organizations are also important and part of where you have strong risk governance. There's a set of values there that are very important. And I think the really, really interesting historical question in this recent episode is how people that made so much money and had such fabulous lives, in many cases destroyed the organization that was providing that. And what was the set of incentives that created that monster? It is, I think, a very interesting question, but one that we really need to think about more. Another question from the audience.
Yes, I still wanted to exploit the occasion of having you here of Canada versus US in two respects. One is, I was discussing yesterday with an executive of Royal Bank of Canada, and saying, are you afraid that people is taking excessive risk in your organizations? And he said, I'm not, because the proprietary trading is basically forbidden. So do you think that this is had a role in the different performance of the two systems? And another question is about housing market and transaction cost. Is there a difference in transaction cost? Is there more viscosity in the Canadian housing market or not? I mean, for example, between Italy and the US, it is like that. In Italy, cost of buying and selling houses there are a lot of cost and issues. So basically, you cannot use a house as as an asset on which you can make capital gain and sell and buy just in one day. So I wanted to ask whether this is the same for Canada or not.
Okay, two questions there. First, by your acquaintance at the Royal Bank of Canada, who's been do something. It's difficult, of course, to make direct comparisons on why banking behaviors emerge, like what was going on in their head. For the most part, I think most of us up here believe, regulation is not the complete answer. You can't just forbid certain things and decide this is what's permitted. And I don't think that's what we were trying to do. Now, we may have forbidden some things. I know our supervisor does. But that's true in any economy. There are certain things banks are not supposed to do. And honestly, I doubt that was the key difference in the outcomes in the two jurisdictions. As I said, Canadian bankers are quite good at arbitrage as well. I think it's inherent in the industry, but they weren't as aggressive. And I think that was because of an attitude that permeated the industry that built up over a matter of decades. The second issue about the housing market. Housing market is quite dynamic in Canada, and I was trying to point to some of our earlier episodes of speculative bubbles, but we didn't have one emerge this time, or at least it hasn't reversed this time. And in fact, that's what worries us. In our financial stability review, the key risk that we see is the possibility that consumers have overextended themselves in the housing market. Mortgage rates are extremely low, as they are, I think, in most economies. And Canadian consumers are using this to pile up on housing assets, which makes perfect sense. But it means we've had housing prices continue to climb, whereas they have fallen everywhere else. So we may only have saved up our problems for later on. So this is what I said, don't brag too much. We could have a problem down the road, and we're very blunt about that. So, but we have avoided it, so I'll take that so far.
Anyone else on this? Any further questions from the audience?
One down the middle.
Right in the row, man in blue shirt.
Yes, this gentleman right here.
Hi, this is directed primarily to Dr. Hughes, but anyone can answer it. You talked a lot about the effects of size on risk and these two countervailing forces of diversification, reducing risk with size, whereas this implicit sort of too big to fail subsidy, increasing risk with size. I was wondering if you could speak a little bit to how you might actually go about measuring this implicit subsidy, if you can do it at all, and whether there are sort of legal or regulatory discontinuities that you could exploit to parse these two channels apart.
Well, the diversification is shifting the frontier. And so the question of whether banks that are larger and better diversified are less risky or not is a question of the endogenous decision they make along that frontier. And I label 3 points that had less risk, the same risk, and more risk of the lower frontier. And the too big to fail subsidy, to measure that is, there's a literature on that. I'm not familiar with all of it. We attempt to measure a subsidy is captured by the control for the price of inputs. But to be sure that we've got it, and we've basically eliminated too big to fail in the structure of the model, we then, as I described, estimate the model, eliminating the banks that we think have potentially the largest subsidy, and predicting out of sample their scale economies. And then we use the estimate in sample and replace the cost of funds for the largest banks with the cost of funds of smaller banks. And we still get those scale economies. So we were not actually trying to measure cost of funds subsidies. We're just trying to imagine how they could be influencing our model and to test the robustness of the model against that.
I think this is an area where there's a lot of discussion at the sort of the bond market level. What do bond rates look for banks? And what might they look like in the future if, in fact, those bonds could be converted into some form of equity or in a failure. So I think that's another place where people are trying to capture how much of an advantage is there right now and how would the risk be reflected, or the contingent capital instruments, which might include this bail-in debt that Eugene mentioned. I think we have time for one last question. Any takers or?
We've got someone back there, yeah.
There we go, right here. This gentleman here. Wherever.
My question relates to franchise value versus value of the firm. Are you referring to a situation where, as for example, if we take Wells Fargo as a bank, so Wells Fargo should have the responsibility to make sure that all of its branches across the country has enough value to ensure the value of the firm, that's Wells Fargo Bank itself. If that is the case, a bank, are you suggesting that major banks are not doing that?
So I think I was approaching this a little more from the perspective of the supervisor or the resolution authority, the institutions that are either trying to make sure the firm is in safe and sound condition, or are going to be charged with realizing the value of the firm, as much value as they can, in order to reduce the cost to society from the failure of the bank, and particularly to the taxpayer. So, I think in that world, the question is, can you determine what the franchise value is? Now, the whole investment banking industry is out there in the normal service of corporations, including financial institutions, to determine what their franchise value is. But I think this is really more from the perspective of the supervisor or resolution authority taking a longer view. Is this something that could be sold? So let me contrast Drexel Burnham Lambert. When that firm failed, as you know, at the heart of it was a criminal enterprise to sell junk bonds. They had no franchise value. That portion of it, there were some other pieces of it that had a little bit of franchise value, but that's a firm that, wasn't worth a whole lot when it was through. If you take a large consumer retail financial institution, it probably has huge franchise value, and if it's sort of competitive, and moreover, it's a very interesting that the FDIC, in its long experience with medium to smaller banks, there is usually more value in the institution than is often reflected directly on the balance sheet, because there's a local area that's being served and a set of clients and et cetera, et cetera. There's a bunch of intangibles that tend to add to value. One of the interesting questions when you turn to the capital markets is they tend to be global markets. They probably have overcapacity, and it's not so obvious how much franchise value there is at the end of the day. Pieces have value. We saw Lehman Brothers broker-dealer sold for a nice price. But when you take the firm as a whole and look at all of the assets and all of the liabilities that are there, are they all going to realize enough value to really protect the taxpayer from taking a loss?